Do not adjust your screen. What you are seeing is real. The price of silver did not just rise today. It teleported. We are looking at a market that has moved $61 in a single trading session. We are trading at $78.83. That is a gain of 8.25% in one day. If you have been waiting for the signal, this is it. This is not a normal rally. Normal markets do not move 8% on a Tuesday morning. This is a liquidity vacuum. It is the sound of the paper market snapping under the pressure of the physical reality. For weeks, we have told you that the price in the West was too low. We told you that New York was trading at a discount to the world. And today, the elastic band finally snapped. The United States price is frantically chasing the global price. But even after this massive explosion, we are still behind. We just received the data from the Shanghai Gold Exchange. While New York is celebrating at $78, China is trading at $83.98. There's still a $5 gap. The magnet is still pulling us higher. In this emergency market broadcast, we are going to dissect the anatomy of this vertical move. We're going to explain why the arbitrage bots are buying every single contract they can find to close the gap with China. We are going to look at the short squeeze that is liquidating the banks who tried to cap the price last week. And we are going to show you why $78 might still be the cheapest silver you will see for the rest of the year. The dam has burst, the water is rising, and the banks are drowning. This is the story of the $6 candle. To understand why silver moved $6 today, you have to understand the physics of a vacuum. In a liquid market, there are sellers at every price level. Someone sells at 73. Someone sells at 74. Someone sells at 75. The price has to chew through these orders to go up. It is slow. It is a grind. But today, there were no sellers. The ask side of the order book was empty. The banks who usually sell to cap the price, they stepped away. Why? Because they are terrified of the Shanghai price. They know that if they sell silver at $75 in New York, they're And when the buyers stepped in, the pension funds, the industrial hedgers, they found an empty room. They hit market buy and the price skipped from 73 to 75 to 78. It met no resistance. This is what we call teleportation. It confirms that the float, the available inventory for trading, has vanished. This volatility is not a bug, it is a feature of a shortage. When you run out of physical buffer, price becomes the only shock absorber. Let's look at the target, $83.98. That is the price of silver in China right now. For the last week, we have watched New York lag behind. Arbitrage traders, the most ruthless actors in the financial world, are forcing these two numbers to converge. They are buying the cheap New York contracts and selling the expensive Shanghai contracts. This buying pressure in New York is relentless. It does not care about technical indicators. It does not care if the RSI is overbought. It only cares about the spread. As long as New York is cheaper than Shanghai, the buying will continue. And right now, even at $78, New York is still $5 cheaper. This tells us that the rally is not over. The arbitrage vacuum is still open. The pressure is still equalizing. We are witnessing the US dollar price being dragged up by the UN price. The pricing power has shifted east and the West has no choice but to follow. Now, spare a thought for the short sellers. Imagine you re a hedge fund that shorted silver last week at $75 thinking it was a double top. You woke up this morning to a $6 loss on a standard futures contract. That is a loss of $30,000 per contract. If you held 100 contracts, you lost $3 million before you finished your coffee. This triggers a forced liquidation. The risk manager at the brokerage firm takes over the account. They do not ask the trader what to do. They just hit buy. They buy at 76, they buy at 77, they buy at 78, and they are priced inelastic. They just need to exit. This short covering acts as rocket fuel. It is panic buying. And it is hitting a market that has no sellers. This creates a feedback loop. The higher the price goes, the more shorts get liquidated. The more shorts get liquidated, the higher the price goes. We are in the middle of a gamma squeeze and a short squeeze simultaneously. It is a perfect storm of financial pain for the bears. You might think that at $78 the physical market would loosen up. You might think dealers would lower their premiums, but they aren't. The market is realizing that $70 was simply the wrong price for a scarce strategic asset. Finally, look at the volume. Today's move wasn't on thin air. It was on massive institutional volume. Billions of dollars changed hands today. This tells us that the big money is participating. This isn't just a few retail traders chasing a chart. They are stepping in at 76, 77, 78. They're building a new floor. The wall of worrying has been climbed. Now we are running on the plateau. So the vacuum is open. The shorts are dead. The East is leading. But silver is not alone in this move. There's another signal flashing red on the dashboard. A signal that tells us this isn't just about silver supply. It is about the stability of the global financial system. Gold just made a move that is statistically rarer than the silver spike. Gold is up $135, 3% in a day. For the world's largest reserve asset, that is an earthquake. In the next section of this broadcast, we are going to analyze the gold signal. We are going to explain why a 3% move in gold confirms a systemic event. We are going to look at the debt markets and the geopolitical triggers that are driving capital into safety. And we are going to explain why silver is acting as gold on steroids. The king has moved, the knight is following. We are watching the checkmate of the fiat currency system. We need to take our eyes off the silver chart for a moment and look at the bigger picture. Because what happened to gold today is statistically more significant than what happened to silver. Silver is volatile. It moves 8% regularly. But gold is the bedrock of the global financial system. It is a $15 trillion asset class. It moves like a glacier until today. Look at the gold price. 2008, when gold moves 3%. It is the market screaming that something in the financial system has broken. It is a systemic distress signal. The smart money, the central banks, the sovereign wealth funds, they are fleeing the dollar. They are fleeing the bond market, and they are piling into the only asset with no counterparty risk. This validates the silver rally. Silver is not going up because of a Reddit squeeze. It is going up because the entire monetary order is being repriced. Silver is simply drafting behind the king. And when the king runs, the prince sprints. This brings us to the concept of high beta. In finance, beta measures how much an asset moves relative to a benchmark. Silver is historically gold on steroids. It has a beta of roughly 2 or 3 against gold. If gold goes up 1%, silver goes up 2 or 3%. Today, gold went up 3%. Silver went up 8%. The math holds perfectly. This is exactly how a healthy precious metals bull market is supposed to behave. This correlation is your safety net. If silver was up 8% but gold We know about the Venezuelan news, but usually geopolitical news spikes the price for an hour and then it fades.